If I told you that most people are asking the completely wrong question when choosing between the fixed and variable rates, and that mistake could cost them tens of thousands of dollars, would you want to know what they should be asking instead? In every discovery call, strategy meeting, whether someone's shopping for a home, up for renewal, or refinancing, the number one question is always the same. Should I go fixed or should I go variable? Here's what most people don't realize. They think this question is about rates. It's not. Well, it is, but it's so much more than that. When you're making the decision between fixed and variable, you're actually making two bets, not one. And most people put all their energy into the smaller bet while completely ignoring the bigger one. I'm Aleem, and today we're breaking down the fixed versus variable decision in a way that most advisors won't tell you. We're going to talk about the two bets that you're making, why the conventional wisdom about safety is often an illusion, and how to actually make this decision based on what matters most. We'll cover what these rates actually are, the two bets that you're making with each choice, the real cost of being wrong, and a decision framework based on flexibility, not rate predictions. All right, let's dive in. The conventional wisdom says that if you're looking for safety and stability, you choose the fixed rate. If you want to save money and can handle risk, you go variable. But here's the problem. That perceived safety with fixed rates can often turn into an illusion because of the massive penalty that breaking this mortgage could cost if you need to terminate your contract early. Let's quickly define what we're talking about. A fixed rate mortgage means your interest rate is guaranteed for the length of the term, typically 5 years in Canada. Your payments remain the same, providing stability. So if you are locked in at 4.5%, that's your rate for the full 5-year term in this example. A variable rate mortgage means the interest rate is tied to the Bank of Canada's prime rate, usually as a discount or a premium from prime. So if you get a discount of prime minus 0.5% and prime is 5.45%, your rate is 4.95%. When prime changes, your rate changes. Now in Canada, there are actually two types of variable mortgage, though both are commonly called variable. There's a true variable rate where your payment stays the same, but the split between principal and interest, it adjusts. And there's an adjustable rate where your payment fluctuates with rate changes. For today, we're going to call both of these variable since the penalty structure is the same, but there is a distinction between variable and adjustable. So what are these two bets everyone makes when choosing fixed or variable? There's the small bet, which is what everyone obsesses over, the interest rate. This is the bet on whether fixed rates or variable rates will be lower over your term. Then there's the big bet, which most people completely overlook, the prepayment penalty. This is about what it costs you if life changes and you need to break your mortgage early. Let's break down both of these. What history tells us is this is the bet most people focus on, whether fixed rates or variable rates will be lower over the term. And here's what the data shows. Historically, variable rates have often been a better financial choice over the long term, even with potential rate hikes. Studies in Canada have shown that variable rate borrowers saved money compared to fixed rate borrowers roughly 70 to 90% of the time over a rolling 5-year periods. Banks aren't stupid. When they offer you a fixed rate, they're pricing in their expectation of where rates will go, plus a risk premium. If a bank offers you a 5-year fixed rate at 4.5%, but variable rates are currently at 4%, that extra 0.5% is partly the bank's prediction that rates will rise, and partly your insurance premium for rate protection. Now, the early 2020s broke traditional patterns. People who locked into fixed rates at 1.5 to 2.5% in 2020, 2021 did phenomenally well. Those who took variable rates and watched them spike to 6 or 7% in 2022, 2023 got hammered. Variable rate holders saw their payments jump by 50% or more in some cases. It was painful. This was one of the fastest rate hiking cycles in modern history. Even knowing all this history, even with the data showing variable often wins, trying to predict rates is still a fool's game. Even professional economists consistently get this wrong. So if you can't predict rates reliably, what should you focus on instead? That's where the big bet comes in. Here's a statistic that should change how you think about this entire decision. Roughly 2/3 of Canadians break their mortgage early, typically around the 33 to 39 month mark. Think about that for a second here. Most people don't make it through their full 5-year term. Why? Why is this? Life's unpredictable. Divorce, relocation, job changes, better opportunities to refinance, needing to access equity for renovations or investments. So the question isn't just which rate will be lower. The question is what happens if I need to get out of this mortgage before the term ends? This is where the rules change completely between fixed and variable. Variable rate penalty, usually a straightforward 3 months of interest calculation. On a $500,000 mortgage, a 4% interest rate, that's roughly $5,000. You know exactly what it costs. There's certainty there. Fixed rate penalty, this is where it gets a little bit murky and sometimes even ugly. It's the greater of 3 months interest or the interest rate differential, called the IRD. The IRD calculation can amount to several percentage points of the mortgage balance, potentially reaching 900% higher than a variable penalty. Let me show you what this looks like in real numbers. Let's say that you had a $500,000 mortgage and you need to break it after 3 years. With a variable rate mortgage, 3 months interest at 4% is roughly $5,000, as we mentioned earlier. With a fixed rate mortgage, if you locked in at, let's say, 4.5% and current rates are now 3.5%, the IRD penalty is going to be greater in this case, and it could be easily $20,000 to $30,000 or more, depending on how your lender calculates this. That's 4 to 6 times higher. And here's the kicker. You often don't know this penalty amount until you actually need to break the mortgage. Think about it this way. Let's say that you save $100 per month by choosing a fixed rate over a variable. Over 3 years, that's $3,600 in savings. But if you need to break that mortgage and face a $25,000 penalty instead of a $5,000 mortgage, you just lost $20,000. All of those rate savings wiped out instantly and then some. There is no amount of rate savings that makes sense if there's a large penalty that traps you later on. Here's the framework that changes everything. Variable rate mortgages have penalty certainty. You know what it costs to get out. Fixed rate mortgages have rate certainty, but penalty uncertainty. Most people obsess over saving a few $1,000s in interest and ignore the possibility of paying tens of thousands just to regain flexibility. Now, this isn't purely a math problem. Your psychological capacity and life situation matter enormously here. Real example here. Sarah took out a $500,000 variable rate mortgage in early 2022. Her payments started at $2,200. By late 2023, payments had climbed to almost $2,900 per month, an increase of $700 monthly. Sarah's a freelancer with variable income. Those payment increases caused her genuine stress. She was losing sleep, constantly checking rate announcements, feeling anxious about her budget. Even if variable ends up being cheaper over 25 years, was it the right choice for Sarah if the stress was affecting her quality of life? That's debatable. Beyond psychology, your practical situation matters. Are you stretching to afford this home? Then you probably can't handle payment increases, even if the penalty flexibility is better. Do you have variable income like freelancing or commission sales? Payment uncertainty might not work for you in these situations. But here's the key. Even if you need payment stability, that doesn't automatically mean fixed is better. You choose variable for the penalty flexibility and budget for worst case payment increases. This is the question most people should be asking. How likely is it that your life will change in the next 5 years? Are you in a stable relationship, or might things change? Is your job security, is it secure, or might you have to relocate? Might you want to access equity for renovations? Could you get an inheritance that you'd want to put towards the mortgage? The more likely change is, the more valuable flexibility becomes. Variable isn't about winning on rates, it's about optionality, it's about flexibility, it's about choices. And variable often makes sense if, number one, you might move in the next few years. If there's any chance that you're going to need to sell before your term ends, the penalty flexibility is invaluable. Number two, you may need to refinance, maybe to access equity, consolidate debt, or take advantage of rate drops. Variable lets you do this in an affordable manner. Number three, you want the ability to adjust without punishment. Life is unpredictable, and you see that, and you value having options. Number 4, your life is still evolving. Career changes, family changes, location changes. The flexibility has value even if the rate isn't the lowest. And number 5, you have financial flexibility. If you can handle payment increases of 20 to 30% without major stress, you can ride out cycles. And keep in mind, there are other options, not just adjustable, but the true variable, where your payment could remain the same and there is payment certainty up to a certain point. Fixed rates can be the right choice, but it should be chosen intentionally, not because it feels safer on the surface. You need to dive in a bit deeper. Fix makes sense if, number 1, you need absolute payment certainty and your budget is tight. Rate increases could cause genuine financial stress. Number 2, you're confident that you won't need to make any changes. You're staying in this home, no refinancing plan, no major life changes expected. Though remember, 2/3 of people are wrong about this. And number 3, you're near retirement with fixed income. You genuinely need stability and are less likely to need flexibility. Number 4, you can absorb a large penalty if needed. You have the financial resources that even a $30,000 penalty wouldn't devastate you. Number 5, the rate is exceptionally low by historical standards. If you can lock in at 2 or 3%, the certainty and the rate are both great. Here's what it comes down to. Instead of asking, where will rates go? Ask this. What would it cost me if I had to change this mortgage? If the answer scares you, that tells you more than anything and any other rate forecast ever will. First, honestly assess how likely it is that you'll need to break this mortgage early. Ask yourself, how stable is my relationship, my job, my location? Will I need to access equity in the next 3 to 5 years? Could I receive money that I want to put towards that mortgage? How confident am I that nothing will change? If there's meaningful uncertainty, that's a strong signal towards variable for the penalty flexibility. Second, can you handle payment volatility? Ask yourself, what's my monthly income stability? How much emergency savings do I have? Could I absorb a $500 or a $700 monthly increase? What percentage of my income goes to housing? If your finances are tight or income is variable, you need to be careful with variable rates, even if the penalty flexibility is attractive. Third, run the actual penalty scenarios. Get quotes from lenders and ask them, what would the penalty be on a fixed rate if I broke it in year 3? What would the penalty be on a variable rate? How do they calculate IRD? See the actual real numbers. If the fixed rate penalty could be $25,000 and the variable rate is $5,000, that $20,000 difference should weigh heavily in on your decision. Fourth, think about the rate environment, but with humility. If rates are historically high right now, variable might position you to benefit when they eventually come down. If rates are historically low, locking in fixed might make sense, but don't make this your primary factor. You can't predict rates reliably, and know this and understand this. Weigh everything together. If you need flexibility and can handle payment volatility, variable is likely better. If you need payment certainty and are confident nothing will change, fixed might work better. If you need payment certainty but might need flexibility, this is the tough spot. You might consider variable with a higher emergency fund budget or accept the fixed rate penalty risk. Once you make your decision, commit to it. Don't second guess yourself. Every time rates move, this is going to cause you undue stress and just make you crazy. You made the best decision with the information that you had at the time. Rates move, life moves faster. Your mortgage should be able to move with you. The biggest mistake is assuming fixed is automatically safer. Safer without flexibility can be expensive. If a fixed rate traps you with a massive penalty, that's not safe. That's risky. Don't choose variable just because the current rate is lower. Factor in your ability to handle increases and your need for penalty flexibility. Most people think, I'll definitely stay put, but 2/3 of people break their mortgages early. Don't underestimate how much life can change, especially unexpectedly. Get specific numbers from your lender on how they calculate IRD penalties. This is significant. It matters enormously. Don't let fear of rate increase push you into fixed if flexibility is more important for your situation. And don't let rate predictions make you choose variable if you can't handle payment volatility. All right, let's wrap this up. The fixed versus variable decision isn't about predicting where rates will go. It's about understanding the two bets that you're making. The small bet, will fixed or variable rates be lower over your term? And historically, variable wins more often, but not always. The big bet, what will it cost you if you need to break this mortgage early? Variable has penalty certainty, around $5,000 in that example that we used earlier. Fixed has uncertainty that could be $20,000 or $30,000 or more in that $500,000 mortgage example. Most people obsess over the small bet and ignore the big bet. Don't make that mistake. The right choice isn't fixed or variable. The right choice is understanding your time horizon, your need for flexibility, and the real cost of being wrong. Once you see that clearly, the rate becomes secondary. Here's what to do next. First, honestly assess how likely it is that you'll need to break your mortgage early. Second, get actual penalty quotes from lenders for both fixed and variable. Third, test whether you can handle variable rate payment increases. Then make your decision based on the complete picture, not just the rate, which is part of the picture. Remember, there is no amount of rate savings that makes sense if a large penalty traps you later on. Think about flexibility first, rates second. Your mortgage should work for you and your life, not trap you into it. Now, if this changed how you think about the fixed versus variable rate decision, hit that like button, subscribe for more content on mortgage and personal finance, and drop a comment. Are you choosing fixed or variable, and what's driving your decision? Thanks for watching, and I'll see you on the next one.